What if I told you Warren Buffett didn't get rich by picking big-name stocks like Coca-Cola or Apple? In his early days, he was buying companies so cheap, they were worth less than the cash they had in the bank. These weren't flashy tech stocks or household names. They were boring, beaten-down businesses that looked dead. And that's exactly why they made him rich. And here's the wild part. This strategy still works today. Stick around, because by the end of this video, I'll show you what these companies looked like and why almost no one's talking about them anymore. I'm not a Wall Street analyst, and I don't work for a hedge fund. I'm just a private investor who spent the last decade studying and testing just about every investing style you can think of, like value, growth, momentum, options, even crypto. But the strategy that made the most sense to me, the one that kept showing up in the histories of the greatest investors, was deep value. I'm talking about buying stocks for less than their assets are worth, sometimes literally for less than liquidation value. It's not flashy. You won't hear about it on CNBC, but that's exactly why it works. Warren Buffett used this exact approach in his early years, when he was just managing small amounts of money, and he made incredible returns. And here's what most people don't realize. You don't need millions of dollars to use this strategy. In fact, it works better for smaller investors who are willing to dig a little deeper. That's what my channel is about, showing you how to invest like the legends, not the influencers. When most people think of Warren Buffett, they picture the billionaire who owns shares in Apple, Coca-Cola, and American Express. But that's not how he got rich. In his early years, before Berkshire Hathaway, before CNBC interviews, Buffett was managing a small investment partnership. He wasn't buying big, well-known companies. He was buying what his mentor Benjamin Graham called cigar butts. These were companies that had one last puff of value left in them. Maybe not great businesses, but so cheap they were almost impossible to lose money on. The idea was simple. If a company was trading for less than the cash and assets on its balance sheet, you were buying something real with downside protection. One of Buffett's best examples was Sanborn Map Company. On paper, it looked boring. They made fire insurance maps, definitely not exciting. But when Buffett looked closer, he realized something wild. The company's stock was trading for less than the value of its current assets. That means if the company shut down and just sold off its assets, shareholders would have received more than the stock price, even if the business was worth zero. So Buffett bought the stock and eventually made a huge return when the market corrected the mispricing. Another example, Dempster Mill Manufacturing. It was a small company that made windmills and farm equipment, and it was a mess. Sales were down, inventory was piling up, and Wall Street didn't care. But Buffett ran the numbers. He realized the stock was trading for less than the value of its inventory and cash, even after subtracting all debts. So again, he invested. He even took control of the company, cleaned it up, and later sold it for a massive profit. These weren't glamorous bets. There was no buzz, no hype, no headlines. But they worked because he was buying assets, not stories. And here's the key. Buffett only used this strategy when he was working with small amounts of money, just like most of us. Once he got too big, it stopped working. There weren't enough tiny, overlooked stocks to move the needle anymore. And big companies are covered by analysts, so it was almost impossible to find mispricings like this among them. But for small investors, for people like you and me, these kinds of deep value plays can still offer massive upside with limited downside. Let's break down exactly what a net stock is and the specific formula Graham and Buffett used, and why it still matters today. So what exactly is a net stock, and why did Buffett and Graham love them so much? It's actually pretty simple. A net is a stock trading for less than the value of its current assets minus all its liabilities. In plain English, you're buying a company for less than what it would be worth if it shut down, sold everything it owned, and paid off all its debts. Imagine you found a vending machine business for sale. The owner wants $50,000, but when you look into it, you see the company has $60,000 in cash, $10,000 in vending machines, and no debt. In other words, you could buy the business, take the $60,000 in cash, and still own all the equipment for less than the cash alone is worth. That's a net. These stocks are often ugly. They're companies in decline. Maybe they've had bad press, poor management, or outdated products. But that's the key. Most investors see the business and run. Value investors like Graham, Buffett, and now people like me look at the balance sheet and say, wait, this thing is too cheap to ignore. Net nets are rare, but they still exist, especially in smaller markets or during downturns when fear takes over. And here's the real kicker. Graham ran studies showing that a diversified basket of net nets consistently outperformed the market over time. Why? Because the downside is limited. If you're buying for less than liquidation value, you have a built-in margin of safety. Not every net turns into a home run. Some go nowhere, some go bankrupt. But when you buy 10 or 20 of these deeply undervalued stocks, you don't need them all to work. Just a few big wins can carry the whole strategy. Buffett once said, "I call investing the greatest business in the world because you never have to swing." With net nets, you're only swinging when the pitch is so slow and fat you just can't miss. And guess what? I'll show you a real-world example of one of these stocks in just a minute, so you can see how this strategy actually works today. But first, let me quickly explain why this style of investing hasn't gone away, and why it still works for small investors who know where to look. So, if this strategy is so powerful, why doesn't everyone use it? Simple. It's boring, slow, and uncomfortable. Net stocks don't make headlines. You won't see them trending on Reddit, and no one's bragging about owning a dusty little Japanese steel company trading below liquidation value. But that's exactly why it still works. Wall Street and most retail investors are obsessed with growth, momentum, and hype. That leaves deep value stocks completely ignored. And here's the kicker. Big money can't touch these stocks. Hedge funds managing billions can't put meaningful capital into a tiny microcap trading at 40% of book value. It wouldn't move the needle. But for small investors like you and me, these are golden opportunities. You just need patience, a strong stomach, and the willingness to buy what others won't even look at. Net nets and deep value plays still pop up, especially in microcap spaces, emerging markets, or when sectors fall out of favor. I've personally bought stocks trading below net current assets, below their real estate value, and even below cash. Some sat flat for a while, some went to zero, but others doubled, tripled, or got bought out. You're not going to get rich overnight doing this, but that's not the goal. The goal is to build real wealth by buying real assets, not stories or speculation. And the truth is, most investors don't want to do the work to find these kinds of opportunities. They want fast results, flashy tickers, and quick dopamine. That's not what this channel is about. Here, we go deep, we stay patient, and we learn how to think like real investors, not speculators chasing the next hype train. Now, I promised you I'd show you a real-world example. So now, I'll walk you through the kind of company that would have made early Buffett lean forward in his chair, a stock that's trading for less than its current assets value, even after subtracting all its debt. It's out there, and no one's talking about it. Alright, let's bring this strategy to life with a real example, one that's hiding in plain sight. The company is called Boss Holdings Incorporated, ticker BSHI. Most people have never heard of it. It's small, it's quiet, it doesn't trade a lot, but it checks almost every box for a classic net investment. Boss Holdings distributes work gloves, pet products, and promotional gear. It's been around for decades, and the business itself is nothing exciting. But here's where things get interesting. As of now, the stock trades around $13 per share. But when you dig into the balance sheet, the net current asset value comes out to about $21.70 per share. That means Boss Holdings is trading at roughly 60% of its net current assets. Let that sink in. You're effectively buying $1 of liquidation value for just 60 cents. That's exactly the kind of discount Graham loved. Now, it's not a perfect company. No net ever is. It's illiquid, meaning the stock doesn't trade much. The business is small and boring, and it may stay undervalued for a while. But that's the beauty of this strategy. You're not paying for future growth or hype. You're buying hard, tangible value with limited downside and real potential upside if the market wakes up. That's what makes deep value different. You're not trying to predict the next hot stock. You're buying dollars for cents, and waiting patiently for value to be recognized. If you're serious about learning how to spot these kinds of opportunities, you're in the right place, because this is just the beginning. In upcoming videos, I'll break down more deep value strategies, share more real-world examples, and show you how to think like an old-school investor in a market full of noise. So if you want to go deeper into this world, hit that subscribe button. And if this video opened your eyes to a different way of investing, just know that was the goal. You don't need to chase hype, you just need to understand value and where to find it.